let's look at the journal entry. This for making it didn't add up. It's not a problem. It's just for illustration purposes. So let's look first of all at the issue of the. So suppose look at this, and it was issued at the face value. So like in our example, the face value is 12.5 million, and investors buying it also 12.5. So there'll be no premium, no discount. So the company Deutsche Finance gets cash, recognizes like the fee. It indicates that it is a face value. And then 5 years pass, 5 years expire. At maturity date, Deutsche Finance repays that amount to investors. So initially it borrowed 100,000, now it repays 100,000. Now liability cancelled and paid. Okay, you may ask me where are the coupon payments? Yes, the Deutsche Finance will pay the coupon payments as well between this date and this date. So payment of interest. So once we recognize interest expense, if the expense is accrued but not paid, you pay interest expense against credit is payable liability. 5,000. So it is a round figure. It will not be affected by anything. This is the 5,000 that must be settled in cash and paid at the end of every year. Okay. Then after the interest rate accrued, after that you pay the interest. So you reduce this debit, this interest rate liability, debit interest, and credit cash. You pay the interest. Alternatively, if you want to do it without accrual, then you just pay debit interest expense, credit cash. You pay the interest. And you do it, for example, 5 times if it is a 5-year bond. And that's very simple. So first of all, borrow money, that $5,000, and on maturity, cancel the bond, read the bond. The more difficult situation is when you have premium or discount. So look at this premium, for example. So coupon rate is bigger than market rate. So the bond is offering more than elsewhere in the market. The price of the bond will increase and there will be premium. So therefore, this is according to the bond contract that you bought, but the amount that you actually got from the investors. Investors will need to pay more. So therefore, you will also have the premium. So credit premium on bonds payable, the difference between these two values. This is the actual liability that needs cash, and this is premium. So premium on bonds payable is an adjunct account. It is account that increases the value. The actual is still 4 million, but the value in your books is more than 4 million. Of course, you can put debit, cash, credit, bonds payable together with the actual liability, but this is really correct. You need to separate actual liability that you need to pay in cash and separate it from premium. So this way, not right. Now you look at discount. The coupon rate is smaller than the market rate. No one wants to buy that kind of. If you want to induce investors to buy this bond, you need to offer discount. So therefore, actual liability is 4 million, but you cash less because bond is not owned by that. So you get 3.7 million. And you will also debit discount on bonds payable. You can that premium payable is like additional income, and discount on bonds payable is like additional thing. So I can here the discount on bonds payable is contra liability account that